Hello and welcome to my April economic and RBA update. And this month we take some deep dives into the following topics. We're going to talk about the US and the Swiss banking failures. It's time we learn more about this global banking system. So we're going to take a deep dive into that. The RBA cash rate decision. It was such a close call. We're going to have a look at that as well. And property prices are growing. Yes, that's right, growing. But is it sustainable or will it turn out to be a dead cat bounce? More on that topic later in the update. But let's first jump straight into the biggest global financial news of the past month. And yes, we are talking about the collapse of several banks in the US, most notably the Silicon Valley Bank, a top 20 bank in the US, and the Credit Suisse Group, the second biggest bank in Switzerland before it was bought out by UBS. And it was also a top 50 global bank by market cap in 2022, according to banksdaily.com. So now let me help you by putting some context around these bank failures. I wanted to give you a 30,000 foot simplified view of the global financial system. So let me first explain how the banking system is set up. The first thing we need to understand is that we have an international organizational level, and that is constituted by the International Monetary Fund, the Bank of International Settlements, and the World Bank. And I suppose they are the overseers of that sort of global layer. Now, in between that, or the next layer down, is what we call the national government layer. Okay, so this is where our fiat currencies, and these are our central bankers. Okay, so in the US, that's the Fed Reserve. Here in Australia, it's the Reserve Bank of Australia. So that is that national government level with our fiat currencies. Then we have the national institutional levels, right? So this is where we have our commercial banks. And we also potentially have our national stock exchanges and also those bond markets. And so the reserve or central bank oversees those operations. And then finally, you get then down into what we call the transactional or firm level layer. So this is where businesses, consumers, and so forth then engage with those commercial banks and do their trading and borrowing of money and exchange of those types of things as the economy, that economic wheel turns. So that is the banking structure, that global banking structure layer at a 30,000 foot view. Now, in terms of what that banking system facilitates is effectively the international monetary system. Now, inside that international monetary system, we have the commodity markets. So you see things like wheat and soybean, coffee, iron ore, gas, oil. That's the commodity markets. Then you have the security markets, and those security markets are the stock exchanges. So that's where businesses from, Apple to Microsoft in Australia to the Commonwealth Bank and to the Commonwealth Serum Laboratory, so CSL, those types of businesses. Then you have the money markets. So these are the short and long-term money markets, the bond markets, and the exchange of money that occurs between transactions from foreign exchange and also the trade that's going on between countries and parties. And then the other big market is the real estate agent market. So you'll see lots of lending that goes on in terms of commercial, residential, factories, all of that type of land control and those types of things as well. So that is a very, very quick overview in terms of what we're talking about there. Now, what we need to remember when it comes to the banking and the global financial system are these 2 points. Number one, money is the biggest commodity and the most important commodity in the world because obviously it's a form of barter and it makes the world function. So if we have a breakdown of that system, we then, or a jarring of that system, or then we have obviously significant deterioration. We know about that in the global financial crisis, which I'll talk about in a minute. The other important thing we need to understand and remember is this whole system is built on the understanding of trust. And so let me simplify that really easily for you. So the simple context is this, that when a bank lends out money, they are taking a risk of lending out that money, and so they charge an interest as part of the contract. Now, they want that money returned back to them. And obviously when it does and the interest is charged, they make a profit for taking that risk on. Now, the money that they lend out is a combination of money that comes from depositors and also international money markets and also central banks. So obviously, as a commercial bank, I'm trying to get the cheapest form of money that I can get. And then ultimately, I want to be able to lend that out and make a profit on that. And so again, how I get those funds comes from depositors, comes from I can access cheap money from offshore, or I can also use the central bank's money in terms of the cash rate and the money that's coming from those central banks. Now, again, I realise this is a very simplistic explanation. For those folks who operate in this space, I can understand there's a lot more complexity to that. But because there is this complexity, it still has to be built on trust. And what we can't afford is any system failures or fractures that can appear, because the potential damaging consequences, they can be really severe. Again, we only need to look back to the global financial crisis, which is referred to as the GFC, for the impact it can have on the global economy. And it takes many years for the economic momentum to continue to rebuild and recover from those big jarring events. So that's why it's the responsibility of the international bankers, in conjunction with the central banks and market regulators, to ward off such risks and to help prevent any systemic ripple effects or contagion occurring in the event of one or more commercial banks failing in quick succession. So this brings us to the story of the Silicon Valley Bank and Credit Suisse failures. Now, over the coming months, we're going to learn more about these specific events and the underlying reasons of each bank's respective failures. But what we do know at this point is both banks experience what is referred to as a bank run, which means their depositors lost that critical trust in them, and then en masse they rushed to get their money out of the bank. Now, to be clear, a bank rush is when a large number of customers withdraw their funds at the same time due to the fears of the bank's pending solvency or insolvency, as it may occur. Now, solvency refers to the long-term financial stability of a business. And in the bank's case, if depositors are taking money out en masse, their solvency gets worse by the minute, because just as we discussed, those depositors are taking their money out, and when that money is taken out, the banks can't on-lend that, and so it obviously impacts their profits. And the money running out the door also means that the bank's balance sheet is also impacted. So these bank runs, can have a very, very quick response, and they can fast track a collapse of any bank, because ultimately the banks aren't keeping all of those deposit funds in cash in a big safe. It's all digital money these days. So what the central banks and the regulators do to help create and build trust and security in the banking sector and each bank themselves. Well, what do? Firstly, regulators make sure that the banks hold sufficient levels of capital, making them safer. But this isn't just in the form of depositors' cash in their bank vaults. They can and they also sell bonds to raise those capital reserves and improve the strengths of their balance sheet. So they raise money on the event that those investors then buy those bonds in the event of getting a return on those bonds. And that obviously shores up the balance sheet, which allows the banks to obviously then borrow more money and lend more of that money out. Now, that's one way. The other thing that the regulators and governments do is they can offer government guarantees to protect depositors, like they do here in Australia. So borrowers in Australia have a $250,000 guarantee, meaning that if the bank goes broke, which is incredibly unlikely here in Australia because they are so very secure, then the government will ensure that their deposit funds are paid back. In the US's case, because there are thousands of banks over there, the regulators have a regulatory model called the Federal Deposit Insurance Corporation, known as the FDIC. Now, this makes the big banks, judged as systematically important, take out insurance to protect their depositors, rather than the US federal government being the initial backstop if the bank fails. As for the thousands of smaller banks, no such guarantee exists. Now, that's important. We'll come back for that in a minute. So in the case of the Silicon Valley Bank failure, the regulators did decide to step in and guarantee the depositors' funds because they were worried about a possible contagion effect. Now, further to this point, they also stated they will assess any future banks' failures on a case-by-case basis, as the impact on that trust or security of the system is absolutely critical. They must shore up that trust and that security. Now, here's where the challenge lies. As a consequence of that action, US depositors are potentially taking their money out of their local banks right across America, and they're putting their money now into depositor guarantor banks, those big banks that are backed by the FDIC bank insurance scheme. So that is a challenge in terms of seeing the risk in those other banks if we start to see runs on those regional banks around America. So it really does make for an interesting story in terms of how it plays out. Now, again, these actions create some layers of uncertainty in the US right now, and it's that uncertainty that could manifest into a bigger banking crisis over there in the US. And given that it's the biggest economy in the world, their banking issues could also have implications in terms of world banking issues if we lose confidence in what happens in the US, and we could see, some type of similar outcome as what we saw during the GFC. So the US banking system imploded, and that obviously had flow-on consequences into other banking areas around the world, including places like Ireland, Spain, all those other places. So it really is quite important. So in terms of what are the regulators doing about ensuring that they're restoring trust and to prevent any further loss of that trust? Well, the regulators in the US have been moving quickly to try and ward off such events occurring after considering they're considering the following tweaks in their setup and systems, which include these things. So close investigations of banks with assets over $1 billion, but aren't considered systematically important. A greater focus on stress testing bank portfolios against tail risk scenarios and potential contagion. Potential changes to deposit insurance arrangements, stronger liquidity rules, stronger capital requirements, and finally, a long-term debt requirement so that banks that aren't considered globally systematically important have a cushion of loss-absorbing resources. So, really strong language coming out of the US regulators. So there's no doubt over the coming months there will be further questions asked of the strength of the banking system and the financial markets in the wake of this rapid tightening cycle undertaken by central banks as they attempt to bring inflation back into check. There are definitely interesting times that lie ahead because some commercial banks are going to be challenged in terms of the cost of funds and any deteriorating lending conditions on the back of these slowing economies around the globe. So my closing comments regarding the financial system deep dive before we move into the data update this month is these points. Banks and monetary markets are highly regulated and, as we've just learned, for good reason. They are the economic plumbing that runs the world. So if the banking and financial sector can't be trusted, then future economic growth is at risk. And what does it mean for people like you and me? Our standards of living will be significantly negatively impacted for an extended period of time. So what is at stake here is that we all have some degree of skin in the game. So whilst we're never perfect and always evolving, you should never forget that the banking and overall financial system has done a very good job in lifting billions of people around the world out of poverty over the last 100 years. Hopefully, this message just leaves some idea of things that you need to mull over and to understand in terms of the importance of the global banking system and in fact what happens in terms of the global monetary markets. So that just gives us a nice overview in terms of what's happened there because it's the biggest financial story of the past month. Let's now move into the regular programming and talk about the US economy. Okay, so let's move now to our regular programming and talk about the US economy. Let's look at inflation first up, and the headline inflation results suggest price pressures are retreating and the Fed is making progress on inflation. However, core measures paint a much more sinister picture as services inflation proves sticky and a possible re-acceleration of core inflation emerges. The Consumer Price Index, the CPI, rose 0.4% in February, down from 0.5% in January, and in line with consensus expectations. Annual inflation slowed to 6% from 6.4% in January, the slowest annual inflation rate since October of 2021. Core inflation, which strips out volatile food and energy items, accelerated to 0.5% in February from a 0.4% increase in January. This was the fastest monthly increase in the core measure for 5 months and beat expectations for a 0.4% gain. In annual terms, core inflation edged down to 5.5% from 5.6% in January. Despite some improvement since the peak of 6.6% in September, core inflation is showing no signs of budging. The story here is similar with what happened in Australia, where services inflation has taken over from the goods inflation story. America is still spending even though the price of goods like travel and accommodation has increased on the back of higher wage costs given record lows in unemployment. The big challenge for the US right now is with the banking system coming under increased scrutiny as some probe to find further weaknesses and risks in the sector. This confidence is challenging their banking system, makes the Fed job a lot harder in one respect, because it might make raising interest rates harder due to the risk of destabilising more commercial banks. Yet on the other hand, if the regulator introduces new requirements for banks to shore up their balance sheets, these higher costs will be passed on as higher interest rates for borrowers and potentially lower profits for banks, making them a little bit more vulnerable. Now, the US can't afford a crisis of confidence. This is the trust story that I was referring to earlier in their system. But from an economic sentiment point of view, the likelihood of the US experiencing a recession as part of their manufactured economic slowdown is starting to look more likely than not. Let's now build on these challenges that the US Fed is facing with a look at their interest rate story. Now, we saw the Fed Reserve Jerome Powell gave his semi-annual monetary policy report to Congress, where he noted that the latest economic data has come in stronger than expected. He also added that this suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. He went on to say there was a long way to go on getting inflation back down to the 2% target. He also suggested that the labour market would remain resilient and that there wouldn't be a very significant downturn in the labour market. Regarding further rate hikes, Powell said that if data warranted faster tightening, they would be prepared to increase the pace of rate hikes. At its March meeting, the Fed lifted the cash rate another 25 basis points to a reading of 4.75 to 5. That's the range. Now that matched the February increase and pushes borrowing costs to levels last seen back in 2007. In Jerome Powell's press conference following the announcement, he said that a pause was considered and acknowledged that the recent banking sector developments are likely to result in tighter credit conditions for houses and businesses and to weigh on economic activity, hiring, and inflation. Now, the US Fed and the regulators are at pains to stress that the banking system in the US is strong and safe, as you'd expect them to say. As to where the next stress test in the system will emerge from is always challenging for regulators and governments to predict. There seems to be some emerging issues in the commercial real estate space, with the risk from low vacancy rates in the city buildings of particular concern. It will be interesting how this sector actually plays out in 2023, given if people aren't returning to offices and doing more work from home, exactly how the viability of those big commercial centres plays out. Closing out the interest rate update for the US, as I mentioned earlier, the Fed has its work cut out as it must decide whether to raise rates in the face of possible banking crisis or to stand idle despite inflation being too stubbornly high. The former could add to financial stresses and spook the market. The latter could signal a lack of confidence about ongoing risk, and it also could spook the market. So they do find themselves in a very tough position. And given they don't release their next cash rate decision until May, there's a lot of water that will flow under the bridge before that meeting. So hopefully there'll be more clearer signs in the US data in this month that will hopefully paint a clearer picture for them in terms of the difficult decisions that they need to make around inflation versus also making sure that their banking system is robust. Looking at the employment data now, and we see the initial jobless claims in the week ending March 25 rose to 198,000 compared to analysis consensus of 196,000, so very close there. This year, initial jobless claims have mostly remained below the 200,000 level as the job market remains strong. Non-farm payroll beat consensus forecast. They rose 311,000 in February compared to expectations of 225,000. January's result was also revised slightly lower to show a net increase of 504,000 jobs instead of the previously reported 517,000 jobs. The unemployment rate ticked up from a record low of 3.4% in January to 3.6% as the participation rate lifted. But employment in the US is still incredibly strong. Looking at consumer confidence and sentiment, we saw consumer confidence surprise to the upside in March, increasing to a reading of 104.2 from a reading of 103.4 in February. This was above consensus expectation for a decline to 101 even. This increase was surprising as the survey was undertaken post the failure of Silicon Valley Bank, which appears to have had little immediate impact on broader consumer confidence, probably because they were a specialist lender in the tech sector and not the broader US marketplace. Retail sales and consumer spending data, we saw retail sales in the US were down negative 0.4% month over month in February, compared to the market forecasts of a negative 3 fall. Now, this is on the back of higher interest rates, higher cost of living, and the back of what we already know around that inflation story. The business data, in terms of business data, we saw support for what the US Fed said about the current strength of the US economy. So activity indicators came in stronger than expected across both the services and manufacturing sector, and the overall business activity accelerated to the fastest pace in 10 months. The composite PMI, a combination of the services and manufacturing indexes, rose to a reading of 53.3 in March, above expectations of a 49.5 and up from the previous month of 50.1. There was an acceleration of activity in the services sector, which rose to 53.8 in March from a 50.6 in February. Services activity was above expectations of 50.3 and was in positive territory for the second consecutive month. Now, the solid demand for services allowed businesses to pass on price increases as the measure of price charges by service providers rose to its highest level in 5 months. Now, that's the issue they are facing with core inflation, as I mentioned earlier. Those services businesses, people are still spending, and so that obviously is a big challenge for them in terms of that, a similar challenge that we've had here in Australia. Meanwhile, manufacturing activity also surprised on the upside, but remained in contractory territory. The manufacturing PMI came in at a 49.3 reading in March, up from a 47.3 in the prior month, and above expectations of a 47% even reading. So in summarising the US economy, it has some really good things going for it in terms of the strong employment story, and it also has had solid gains in terms of the wages growth over the past couple of years. But the real impact of high interest rates and the risk of stubbornly high inflation are challenging, and they need to be overcome, especially now that the financial system is being tested with the likelihood of more rate increases to come and the likelihood of rate cuts later in the year, according to the Fed, are increasingly unlikely. So it does look like there will be higher rates in the US for longer. Let's turn now to China, and there's not a lot of huge amount to report on this month in China as they continue to ramp up their economy. On the inflation front, we saw inflation pressures in China were softer than expected in February, suggesting that the rapid reopening of the country won't add to any flow-on global inflationary pressures. The consumer price index, CPI, rose 1% over the year to February, slowing from a 2.1% annual gain in January and falling short of expectations of a 1.9% rise. This was the softest increase in the CPI in 12 months. So they've got no challenge with inflation right now. In terms of their interest rates, the People's Bank of China, the PBOC, kept its key lending rate steady on the back of basically no pressure around inflation for the seventh straight month in the month of March, fixing as widely expected. The one-year loan prime rate, the LPR, which is the medium-term lending facility used by corporates and household loans, was left unchanged at 3.65, while the five-year rate, which is a reference for mortgages, was maintained at 4.3%. Employment data now. Chinese surveyed urban unemployment rate edged up to 5.6% in February from 5.5% in the previous 3 months, pointing to the highest level since last November. The unemployment rate of the population aged 16 to 24 and 25 to 59 was 18.1 and 4.8 respectively, meaning that there's a lot of unemployed younger people, but as you get older, most of them are finding employment. Now, we would expect that to obviously improve as the economy grows, whilst the jobless rate in 31 large cities and towns stood at 5.7%. Business data now. The Purchasing Managers Index, the PMI, rose to 54.2 in February, an uplift of 3.1 points from the outcome in January. The Services PMI also recorded a solid increase, rising from 52.9 in January to 55 in February. They are really starting to gear up. Both indexes are suggesting activity in China will expand in coming months as they recover from the difficult 22 period after the tight COVID restrictions. Let's now look at the Eurozone and Europe in terms of their data, and we start again with the inflation story over there. The consumer price inflation rate in the Euro area eased to 6.9% year on year in March 2023, its lowest level since February of 2022, and slightly below market consensus of 7.1% reading. This preliminary estimate showed. Still, the reading remained well above the European Central Bank's target of 2%, and the core inflation, which excludes those volatile items such as food and energy, hit a fresh record high of 5.7%, putting pressure on policymakers to push on with further interest rate hikes. Now, this is again a segue into the interest rate story now, and we saw that the European Central Bank, the ECB, increased its interest rate by 50 basis points to a reading of 3% is their cash rate. This is even though the collapse of the Credit Suisse took place over this time. However, the ECB President, Christine Lagarde, did note that given the current banking situation, she said it was not possible to determine the future path of rates given market turmoil that could hit credit conditions and dampen confidence. So a little hint there in terms of what she's thinking. Now, time will tell us how this plays out over the preceding couple of months, as we will discover if there are any other commercial banks struggling in the Eurozone or Europe more broadly, and even the UK for that matter. In terms of their unemployment data or employment data, we saw the unemployment rate in the Euro area stayed steady at 6.7% in February. Retail sales now, and we saw retail sales data showed an increase by 0.3% over the month to January 2023. This was weaker than the 0.6 increase the market was expecting and comes on the back of the upwardly revised 1.7% decline in retail trade over the month of December. So sales were up on food, drink, tobacco, and non-food goods. Online trade dropped for the fourth consecutive month, and fuel sales declined. On a yearly basis, retail sales declined by 2.3% year to date into January. Looking at consumer sentiment, we saw consumer confidence was effectively unchanged in March, falling to a reading of negative 19.2 in the month from negative 19.1 in February. The outcome was below consensus expectation of a negative 18.2. Confidence has remained firmly entrenched in negative territory, but has lifted somewhat from the cycle lows of a negative 28.7 in September. Closing out Europe now, we're talking about the business data. We saw economic activity surprise on the upside, beating expectations and rising to a 10-month high as it moved further in expansionary territory. The Composite Purchasing Managers Index, the PMI, a combination of the services and manufacturing indices, lifted to a reading of 54.1 in March. This was up from 52 even in February and above expectations for an unchanged outcome. Activity has now been in expansionary territory, and remember, expansionary territory in all of these indexes is above 50, and that's happened for 3 consecutive months. The outcome reflected a rise in the services PMI up to 55.6 in March from 52.7 in February, and again, this was above expectations of a reading of 52.5. Now, seeing the business data in explanatory territory is positive news. That's a definitely positive news story coming out of the Eurozone. But like most other developed nations, they are still facing an uphill battle more generally in their whole economic zone, with inflation continuing to damage short-term economic prospects, and in terms of what happens then with interest rates and any contagion effects we see off the back of that. So that wraps up our worldview. Let's now turn our attentions back home to Australia. And obviously the biggest news of the day comes to the Reserve Board's decision. The Governor and the Board met to announce what is very much a most anticipated and much debated rate call, as economists across the country were very much divided as to whether the RBA would continue raising rates for the 11th consecutive time or if they would finally take a pause. Now, the verdict, drum roll, well, the cash rate has been put on hold, with the official cash rate remaining at 3.6%. A welcome call for households with mortgages is an understatement after having enjoyed record low interest rates for several years. This doesn't mean, however, that the RBA is done with raising rates just yet. Whether they are done for the short term all rests on how quickly inflation continues to cool. If inflation remains stubbornly outside the RBA's 2 to 3% target range, we might see further rate increases, and as early as next month's board meeting, if the March quarterly inflation read is higher than they'd hoped for. Time will see this play out, but for now, good news, we have a pause. Let's now take a look and unpack what led to the RBA's decision today, starting with the inflation story. The monthly consumer price index, the CPI indicator, rose 6.8% over the year to February, well below consensus expectations for a 7.2% gain. The measure has now fallen 1.6 percentage points since December, suggesting disinflation is beginning to take effect. Remembering, that's my buzzword of 2023, disinflation. Now, housing was plus 9.9%, food and non-alcoholic beverages was plus 8%, and transport was 5.6%. Now, they continue to be the largest contributors to the elevated inflation, although it's hopeful that these items are still continuing to cool. We talked about the service inflation being the current inflation headache, especially holiday and travel accommodation. The good news is we are seeing a rapid easing over the first 2 months of 2023 after our big spending splurge that we did over the Christmas and New Year period that we saw in the December quarter inflationary data. Prices for new dwelling construction and electricity are coming off the boil. Now, if I was a betting man, and I'm not, but if I was, I'd continue to bet construction costs will continue to cool further. But given the mess in our power generation industry, thanks to 20 years of government incompetence, our power prices still look set to be an inflationary problem over the next 12 months at least. Now, other good news, oil prices are on the way down, and this is having a positive impact on fuel prices, which is also starting to show up in the data. Now, as I declared in my last update, the latest inflation cycle peak was December last year. However, this doesn't see us out of the woods just yet, with the risk of the odd spike, like when we get maybe the March inflation data. That could be the reason. But on the whole, the RBA policy setting is slowing the economy to rein in inflation, and they're making good progress on this. Let's turn our attention now to the employment data, and we saw that the job vacancies fell by around 1% between November and February. This was the third consecutively quarterly decline in the number of job vacancies. Compared with the peak in May, job vacancies are now down 9%. Expanding this point a little further, the percentage of businesses reporting at least one vacancies fell from 28% in November to 24% in February. The number remains elevated at around double what was before the pandemic. To be honest, this surprises me a little, as it still remains as resilient as it has for as long as it has. I suspect to see further deterioration in job vacancy numbers as the economy slows further throughout 2023. The unemployment rate improved back to 3.5% in February from 3.7% in January, which was alluded to in the RBA minutes of the February meeting. There was a solid bounce of 64,600 jobs created in February, the highest monthly increase since June of 2022. The strong read reflects a rebound for the 27,500 jobs lost over December and January due to seasonal changes. The working age population increased by 47.7 thousand in February and by 136,600 over the 3 months to the year ending February. The number of people in the labour force increased by 48,000 over February. This suggests that the overseas arrivals coming into Australia are getting jobs. The overall participation rate ticked up to a reading of 66.6. Now, the number of unemployed declined by 16,500 over February. This was the first decline after 3 consecutive monthly increases, totaling 37,500 jobs. The two driving forces for a deteriorating unemployment story remains the slowing economy, resulting in slower demand for labour, and the arrival of new migrants increasing the labour supply. So I think the unemployment story that we've got now is as good as it gets. Consumer sentiment data now, and we saw consumer sentiment remained in recessionary levels in March, unchanged from a February reading of 78.5. There have now been 3 readings below 80% over the past 5 months. Now, for context, the last time we saw this cluster of readings below 80 was during the 1990 recession. The sub-indices on the negative side were near-term views of family finances and economic conditions over the next 12 months declined, as well as the time to buy a major household item index dropped to its lowest since the global financial crisis. Interestingly, on the positive side of the coin, views on family finances over the last 12 months improved, and consumers were optimistic about the long-term economic outlook, obviously indicating that some folks are now seeing past the current RBA cash rate cycle. Sentiment in the housing market landscape remains complicated. As affordability is stretched, the time to buy a dwelling sub-index dropped to a reading of 65.7, its lowest since 1989, when interest rates were at 17%. That makes sense to me with the quick increases we've seen in interest rates back then and what we're also seeing now. What is surprising, however, is the data read on house prices expectation, which rose by 8.6% to a reading of 111.7. Now we know that house price values have been falling in most states and territories over the last 12 months, but the pace of price falls has been moderating these last couple of months. And we even saw property values increase in Sydney in February. And now, based on the latest CoreLogic data that I'll be sharing with you shortly, the median price in Australia is actually grown in March. So reconciling these contradictions of housing affordability with a terrible reading there versus price increases isn't easy, especially in the rising interest rate environment. Something else is at play here, and I think it's got a lot to do with the story of demand versus supply, which I'll talk to more in the property section of this update later. Retail sales and consumer spending, and we saw that the retail sales result in February was an increase by just 0.2%. We saw the soft reading is evident in the retail spending continues to slow, even though this figure suggests that we had growth in spending. If you look over the last 3 months, spending has fallen by 1.5% compared with spending over the previous 3 months, which was the September to November period last year. When you also adjust for population growth and inflation in the data, it's an even bigger slowing story, as demonstrated by looking at the retail spending in the working age population data. Let's take a look at that. Spending over the past 3 months in this space has fallen by 2.1%, which is the largest quarterly fall on record outside of COVID-impacted data. With the cost of living pressures, we will continue to see downward pressure on spending, whilst a strong growing population would put upward pressure on the same numbers as they settle into a new life in Australia. It's my view that households will continue to watch their surplus savings getting eaten up by higher loan repayments or rents, and spending overall will continue to cool off even further. Business data now, and after a brief reprieve over that holiday period of positive business sentiment, which I highlighted in last month's update, the mood among businesses has slipped back into a pessimistic territory. Business confidence dropped 10 index points to a reading of -4, the weakest reading since December of 2021. It's also the biggest monthly drop in 14 months as businesses start to face the true reality of a slowing economy. Forward orders declined, suggesting conditions are likely to weaken in future months, but the current conditions index is still at +17, down -1 index points. One suspects this will continue on a downward trajectory from here. So before we talk about the property story, I want to close out the story on interest rates by having a look at this latest data and recapping this latest data. Prior to today's RBA cash rate decision, mid last month, Governor Lowe talked about 4 key points that would influence today's decision. They were the employment story, business conditions, inflation read, and finally consumer spending. Now, they are the main data points we've also been focusing in on. Now, given that we've just learned about this data, we can see that on balance, although it was a tight decision, the RBA board opted to pause for now to allow for this record tightening cycle to play out a little bit more. They would have also taken into consideration that this month several hundreds of thousands of fixed mortgages expire, meaning those households are also going to have a significant increase in their costs going forward. And just on a final point to remember here, and I mentioned this a bit earlier in this update, but the RBA made it clear they may not be done yet in terms of increasing the cash rate further if inflation data remains too high and doesn't continue to keep falling. If we continue, this is on us, if we continue to keep reducing our spending, then inflation is put under further pressure as businesses can't keep passing on cost to us, and the rates will stay where they are for now, and eventually rates will come down to a more normalised level over time once again. So it's a positive day for mortgage holders, but don't just go out there and celebrate by spending more. There's more work to be done here. Okay, so that wraps up the business story. Let's now talk about the property data. starting with lending data, and the value of new loan commitments for housing fell 0.9% to 22.6 billion in February. Now that's seasonally adjusted, and that's also after a revised fall of 2.4% in January. The value of new owner-occupied loan commitments fell 1.2% to a reading of 15 billion in February, whilst the value of new investor loan commitments fell 0.5% to 7.6 billion. Since January of 2022, new loan commitments have fallen by 33%, as banking servicing calculators have been hit by higher rates and the very high buffer rate of 3% introduced by APRA is still in place. So people just, even if they want to borrow, are finding it difficult to get servicing and borrowing that money. Looking at building approvals now, we saw the total number of dwelling approvals rise 4% in February in seasonally adjusted terms, following a 27.1% fall in January. This increase was driven by an 11.3% rise in approvals for private sector houses after a 10-year low in January. The result remained 13.6% lower than February 2022. Private sector dwellings, excluding house approvals, fell a further 9.5% in February, following a 40.3% decline in January. And it's at its lowest levels recorded since July of 2012. Falls of this side in terms of building approval, falls of this side are going to put ongoing pressures on housing as the undersupply of housing level continues to increase, yet our population growth continues to rise with increased migration into this country. So it very much is a challenging time in terms of supply of housing. Looking at the property value results from CoreLogic now, as I mentioned earlier in my intro, CoreLogic are reporting dwelling values actually increased by 0.6 across Australia in March, led by an increase in Sydney of 1.4%. It's not all smooth sailing though, with Adelaide, Canberra, Darwin and Hobart all recording falls. In fact, Hobart now takes the lead in terms of the biggest price falls post-market peaks across all of our capital cities, with a 12.9% fall so far in this cycle. Now they take the mantle over from Sydney. In some better news for Hobart, price falls have been moderating over the past 3 months, but the demand-supply imbalance is still in play in the Hobart market, which we'll see and still put downward pressure on prices. Let's step through the numbers that we see across the capital cities. So we saw Sydney again at 1.4% positive. Melbourne was positive by 0.6%. Brisbane eked out a positive result of only 0.1%. Adelaide was almost flat, but it was a negative 0.1%. Perth was a positive 0.5%. Hobart negative 0.9%. Darwin negative 0.4%. And Canberra negative 0.5% for the month. In terms of combined capitals, it was positive 0.8 when you think about the weighting average that you put on Sydney and Melbourne. That's why it's positive 0.8. Combined regions, those regional areas also eked out a little bit of growth with a positive 0.2%, leading to the national result of a positive 0.6%. So the big question here is, why are property prices going up when interest rates have been going up too? Well, as Bryce and I have been telling you for many years, short-term prices are a product of demand and supply imbalance at that moment in time. And in the case of the residential property market here, right now, supply for dwellings for sale is about 20% less than the previous 5 years average. Yet sales activity is roughly 7% below the previous 5 years, meaning there is enough demand currently to support the prices being offered for property. We also need to acknowledge in some cases property values are off by around 10 to 15% in some markets, and in other locations they're off by as much as 20 or even 25% lower than their peaks. So we need to recognise the context here, that buyers are either seeing value or they're running out of patience. And in the current cases, more so than what was happening last year, there appears to be more properties with competing buyer interest due to the lack of stock for sale, and this is pushing values higher in some areas. So this brings us to the big pressing questions. Will more sellers now come into the market given prices are rising again in some markets? Will more buyers now come into the market given they didn't think that the bottom of the market would come so quickly? Is it in fact the bottom of the market, or is it a dead cat bounce? Meaning that if more sellers list and demand doesn't increase, will this see prices start to fall again? What about if demand increases further and sellers still hold off? Will property prices increase more strongly in the short term? These micro trends aren't so easy to predict. And to this point, what does it matter in terms of what's happening nationally? I've been telling you for years, there is so many things and there's no such thing as a national property market. You can't buy it. The property market is made up of hundreds of sub-markets. So whether you're buying for owner-occupied purposes or for investment purposes, what you need to focus on and what you need to care about is what's happening from a demand versus supply story in the local area that you're buying. This is where you'll discover and take advantage of buying property opportunities in those particular locations. These macro trends aren't so easy to predict. And to this point, what does it matter in terms of what's happening nationally? I've been telling you for years there's no such thing as a national property market. You can't buy it. As a buyer, whether you're an owner-occupier or an investor, you need to focus in on and care about what's happening in the demand and supply story in your local market. This is where you'll discover and take advantage of the property buying opportunities in those areas, irrespective of what's happening nationally. You should never forget this message, but just as importantly, you should never forget the message about what drives long-term sustainable price growth, because you can see markets get out of imbalance and people paying too much for property in the short term as well. And what I'm talking about in terms of long-term sustainable price growth, we are talking about looking at land value and what makes it go up higher. Its location, its exclusivity, its desirability, its productive use. And you combine that with human interest and human behavior. Like at the end of the day, remember, property prices, owner-occupiers, they buy emotionally with their hearts. So you're going to be looking at that. You're also going to be looking at the localized economy and how big that economy is and the incomes that are driving in that economy, that knowledge center. That is all what drives sustainable long-term property price growth. Now, if you get this mix right, you'll enjoy very strong long-term capital growth performance, and you won't be too concerned about what happens from a month-to-month basis. You'll be more thinking about what's happened over that 5 years or longer as you enjoy those long-term capital growth stories. So Bryce and I have said before, and we'll continue to keep saying it, that the best time to buy a property is when you can afford to buy and hold it for the long term. If you thought you could pick the bottom and you haven't already acted now, you might have just missed the opportunity in some property markets across Australia, because we are seeing growth in those particular areas. So it really is an important message to sort of say, plan for the long term, execute for the long term, not for the short term. But for those people who are in a position to buy, and if you haven't already done so, you may have, now there is still some downside risk here, but you may have missed that opportunity in terms of picking the bottom. And that's the story I've been trying to tell you over the past couple of months, in terms of it was getting closer and it may have come earlier than most people may have understood. All right, so in summarising the overall story here and wrapping up the update for April, I want to firstly summarise the global economic story outlook by talking about the developing stories that are centring around the banking and the financial system, and how this will continue to be coped with in terms of rising interest rates and that difficult balancing act between inflation and also what's happening in regards to those interest rates on the broader economic outlook in those particular markets. So inflation is still remaining stubbornly high, so we need to see an improvement in that level, but that's going to be very difficult for those central bankers if we have some banking instability. Now, in summarising the turning data points that we've talked about here today in terms of the Australian market, this is how I read it. So the situation is the economy is definitely slowing further. Unemployment will rise from this point forward. Consumer spending will slow further. Inflation is cooling. Business conditions are also cooling. We now have a clear picture in terms of what's happening with interest rates. That's unless something out of the blue happens, right? So we've got a clear pathway of interest rates now that we're pretty much done. In terms of how the property market now acts, in terms of we now need to see what's going to be happening with sellers that have been sitting on their hands. Will they come into the property market now? And what about the depth of demand and the buyers? The ones who have also been sitting on their hands thinking it's going to get worse before it gets better. That is now going to be playing itself out. So it's very, very interesting times ahead. You certainly wouldn't be dead for quids, would you? I love this stuff. There's lots going on in this particular space. So I'm really looking forward to our next update next month. But until then, always remember, knowledge is empowering, but only if you act on it. And we'll see you next month.